All right, welcome to tonight's broadcast, Wall Street's Dirty Little Secret. It's a webinar hosted by myself, Jerry Robinson, and I have a special guest tonight, Barry James Dyke. I'll be explaining who he is in a minute and who I am as well. This is a part of the FTM Daily webinar series that we do. We try to do one of these each month. It's a free educational webinar. We always do these for free at the time. This one in particular is going to be placed on our website for free, so it'll be perpetually available. You'll be able to go there and download it. So just make use of this. Feel free to send it to friends and family, whatever. It's called Wall Street's Dirty Little Secret. Let me tell you a little bit real quickly about who you're going to be hearing from tonight. It's myself and Barry. First of all, I'll introduce myself. Many of you, by the way, when you filled out the registration, appear to be new to our website, and we're very, very, very excited about that because we have been growing this website and growing this organization for some time, attempting to help people with their personal finances, help people understand the global economy, help them understand what's really happening, finding the truth. You know, there's so much smoke and mirrors that goes on out there on Wall Street, out there in Washington. It's just unreal. And so what we try to do is get down to the very nitty-gritty, get down to the truth. And that can be very hard to do. It can be very hard to follow the money, and that is, of course, our organization, FTM, Follow the Money Daily. Our website is FTM Daily. I am the founder. My name is Jerry Robinson. I'm a trained economist and the president and founder of Makers Group Financial. That's makersgroupfinancial.com on the web. You can find all of our services and products there. And I'm a columnist. You may have seen some of our work on townhall.com, on financialsense.com, on some of the different places that pick us up, dollarcollapse.com. There's a lot of places that run our columns. We have a daily column, by the way. We got a question about this. Somebody said, how do I get the daily column? Well, just go to ftmdaily.com, and you'll see that every day we post a new column, myself, or we also have a correspondent based in Tel Aviv, Israel, so he reports from that side of the world. And so he produces a daily column, and I produce a daily column, and so together we kind of cover the globe. The book that we put out, by the way, is Bankruptcy of Our Nation. If you have not picked up a copy, you can pick it up there, 12 Key Strategies for Protecting Your Finances in These Uncertain Times. We also host the Follow the Money Weekly radio program that's held every single Saturday morning. It's available for download for free on our website, iTunes, oneplace.com, so many different places you can download that. We're also in some select radio markets across the country. We also publish a newsletter called the Follow the Money Quarterly newsletter, FTN Quarterly. We'll talk about that briefly a little later. We'll have a couple of commercials throughout this free broadcast. So that's who I am. Let me tell you about my guest tonight. My guest is a good friend. He is also a very good researcher. He has uncovered some very interesting information about Wall Street. He is a financial advisor. He's the author of a book called The Pirates of Manhattan. He's the president and founder of Castle Asset Management, LLC. He began his financial services, started cutting his teeth back in 1982 on this whole business. He's a student of Austrian economics, which makes him a friend of us. FTM Daily is a strong, ardent supporter of Austrian economics, that is the type of economics that we promote. And he's also a proponent of sound money, that is printing money out of thin air, as the Federal Reserve does, is bogus. And so that's obviously what a proponent of sound money means, something that's backed up, a currency that has some sort of backing. And so that is where he's coming from tonight. By the way, his book, The Pirates of Manhattan, I was turned on to this book 2 or 3 years ago by a good friend of mine and was very surprised by the book, learned a lot from the book. It was one of the more eye-opening books that I read in my research for the book that I wrote, Bankruptcy of Our Nation. And I'm very honored to have him along tonight. He's ended up becoming a good friend of mine. He's also a part of our Christian Financial Advisor Network that's on the web at cfanetwork.org. So he handles a lot of referral business, and just a very good guy. He brings a lot of interesting things to the table. The book, The Pirates of Manhattan, delves into some of the very interesting things that we're going to cover tonight in this webinar. And so, Barry, without further ado, I just want to move right into this. And before I do, let me double check and see if we have any questions up to this point. We don't. Okay, no questions yet. But again, friends, if you do have a question along the way, feel free to type that in. and we'll get to that as quickly as we can. At the very end, if you just want to wait, at the very end we will have a time for Q&A. So feel free to wait or to type it in as we go. Barry, can you hear me okay?
Great. Can you hear me, Jerry?
Absolutely. Barry, great to have you here tonight.
Well, thank you very much. It's always a pleasure, Jerry, and you're a great guy, and you're a good student of this stuff, so let's get on with this.
Absolutely. Okay, well, let's move right in here to the presentation. Before we have Barry go on, I want to tell you real quickly what we're going to be covering. Those of you who subscribe to our FTM quarterly newsletter or you understand our financial philosophy, you know that we have 5 levels to financial freedom. Number 1, build an emergency reserve. Number 2, asset, income, and life protection. Number 3, build and diversify final reserves. Level 4, build a diversified investment portfolio. And then level 5, that's time for advanced investing, speculative options trading, advanced real estate strategies. So we kind of go in that order. Everybody starts at level 1, and we move all the way down. Tonight we're going to be talking predominantly, for those of you who are interested in, you're following this, many of you follow this plan, we are going to be talking about level 4, which is investing broadly across various asset classes. And we're also going to be talking about insurance planning, asset, income, and life protection. So we're going to be talking about both of these levels tonight in our presentation. So those of you who are wondering where we're going, this is where we'll be going. All right, Barry, why don't you get us started here? Looks like we're pretty corrupt at Wall Street, eh?
Okay, yeah, that's about, someone had sent me that, too. I forget where someone sent me that from, when the Pirates of Manhattan book came out, someone picked up in the New York papers about that they were picking up the thing on the Somali pirates, and so the Pirates of Manhattan, I'm kind of an underground cult hero at this point. So that's just a first slide.
Well, let's talk about the Roaring 2000s. You have some interesting facts here. Let's go through some of these here. The Roaring 2000s. Yeah,
this is the thing is in the high-tech meltdown, Jerry, people lost 5-7 trillion in the stock market. And the reason I'm putting this thing up here, I came up with this before my book came out, but before the meltdown of 2007, and we still haven't recovered from that, people lost 5-7 trillion investing primarily in high-tech.com stocks. And that was before this. And in 2007, there was over 8,700 mutual funds, and 94% of them don't even beat the S&P. So mutual funds really don't work.
So there were 8,700. There were currently 8,700 mutual funds. 94 of them did not beat the S&P during.
94% of them did not beat the S&P. That is correct.
During what time frame?
Oh, gee whiz, that's, I don't know, over quite some time. It was over like a 20-year period.
That's amazing.
Then thirdly, this is and I repeat this because this came out in May of 2007. I said there was 8,000 hedge funds which are not regulated and use tremendous leverage and 10 to 1. And then I suggested that derivatives was going to be proposed a very large economic calamity, and then it did happen. As you know, you've read the book, Jerry, and then it all came true. And actually, the amount of leverage of 10 to 1 was actually small. When someone like Merrill Lynch or Lehman Brothers or Bear Stearns or even Goldman or Morgan Stanley were leveraged 30 to 40 to 1. So these are all facts, and but most people don't know that. But these are all true. And the reason why investment banks are actually were leveraged as of 2004, 40 to 1 legally, and that was the result of lobbying by Goldman Sachs with the SEC. So these are the facts. These are all these things led up before the crisis, Jerry. Okay, yeah. This is what I found some very interesting. These are all world-renowned economists who got their PhDs in economics and Nobel Peace Prizes, by the way. And these are what they said about their how they felt about investing in the Los Angeles Times, I believe. He said, "I'd rather spend my time enjoying my income than bothering about my investments. Know that my mix of retirement investments is utterly stupid. In retrospect, I would rather have been better off put more in stocks when I was younger. And then I think very little about my retirement savings because I know there could be maybe poor or more miserable or both." My point is that here's what Markowitz and a bunch of these economists were saying in 2005 about their own investments. And so if we have Nobel laureates with PhD in economics can't manage their retirement plans, how can normal, regular old people do that?
I think part of this, and obviously we're going to get into this tonight to show just how stacked the deck is against the individual investor. But in Wall Street, Barry, it's becoming very, especially as we look back over just the course of the last couple of years, the institutional money has flowed in and has just taken advantage of this huge doubling of the S&P 500 off of the bottom back in March of 2009. We saw this massive 86% surge in the Dow since March of 2009. Mm-hmm. And now here comes the individual investor. They're all hot and ready, and they're ready to start putting money in. And then, of course, we have a day like today. And for those of you who are listening to this maybe 2 weeks afterwards, today was one of those days where, just kind of a sucker punch where we moved backwards about 5 months. Stocks hit, in some cases 5-month lows. And so there's a whole lot of volatility going on. There's a lot of speculation that's going on, Barry. And what many people don't understand is that this game is rigged. It is completely rigged.
It's totally rigged.
And it becomes very difficult for an individual investor who walks out and, he's walking into this glorious casino of Wall Street and he's hoping to retire. And we're taking a look, the Wall Street Journal put out an article the other day talking about 401ks, and we're going to get to those tonight. But just how so many people are failing to meet the mark. And here you have these Nobel Prize winners in economics who, you would think these guys would know how to invest. If anybody. And it kind of makes sense. And later on, we're going to talk about where some of the federal government workers themselves and those who in the know, where they're putting their money. It's very interesting.
Yeah, and as you know, Jerry, all this research has been presented to a lot of people. But this is over here, Kenny Lay. This is what Ken Lay said. My personal belief is Enron stock is an incredible bargain, the current price. And we'll look back a couple of years from now and see what a great opportunity we have. And he said this, was it 2 months before Enron collapsed? Hmm. And so we're seeing the same type of thing today. And I think 91% of people's money at Enron was in 401k money was in their Enron stock. So we're seeing this type of thing over and over again. And the reason why I get this is because that's what Ken Lay remembers him. Myth of diversification. Warren Buffett says, asset allocation is Wall Street obsession and pure nonsense. And I agree with him. Actually, Warren Buffett's been probably the best conglomerate ever, but even his diversification is starting to blow up in a lot of respects. So you can't diversify away risk, Jerry. When the market goes down, anything without a guarantee gets clobbered. If listeners out there, if they haven't read the book, I highly recommend the book, The Black Swan. Nicholas Taleb says, you should have 85 to 90% of your assets in extremely safe investments. That way, if you do have a market crash, no black swan can hurt you. And lastly, and I think really the best offensive effort is to invest in yourself with concentration of effort. I always believe the best invest for anyone out there and anyone listening is in themselves first. And diversification is really a way to protect assets, but not a way to really make money. So if you're going to make money, you really have to concentrate your effort, like you're playing a sport, whatever the case may be.
Define what you mean by investing in yourself. You mean starting your own business, or what do you?
Everyone has some God-given craft. Everyone has some God-given craft within them, whatever, whether it be their own business or starting their own business, or just getting better at what they do, and stop listening to this Wall Street drivel about trying to make money by diversifying in mutual funds. The best thing really is investing in yourself, whether it be educating yourself or going to the gym or who knows what all, to take care of yourself first. And I guess, does that make sense, Jerry?
Yeah, I think also there's many people who would, realize that so few people actually make, their fortunes in the market. Instead, they make it their own business. They make it through real estate. Trying to get into the market and swing trade or day trade or parlay yourself into a fortune, unless you've got a lot of time, and unless you've got a lot of time horizon, the chances of actually striking a fortune are extremely small, aren't they?
Yeah. Matter of fact, I'm writing this another book, as I told you, and I had to address this fact, is that 90% of the people who make their wealth in this country are $5 million or more, and this is the Harrison Group out of Connecticut, came out in 2007. 90% of the people make their money in the small business profession, something where they work at long periods of time. The excellence, it comes with a price, and the problem is that people do not make their money in speculative investments. They just don't. The only people who make it is Wall Street.
Mm-hmm. Yeah, and we're
really on a whole.
We're going to show that tonight for sure. Well, let's talk about some of the ideas of foreign international diversification.
Oh yeah, this is one of the latest fads. This was what, this was data from 2007, and now the new fad, as you know, Jerry, is the target date funds. But this before in 2007, the latest fad was the international funds, and the reason why I put that up there is because everyone said at that time in 2007 you could put your money in international stocks. And the funny thing is that although we got hammered in 2007, 2008, various indexes in the UK, China, India, Japan, Hong Kong, France, Germany, all got clobbered. I mean, actually, we were kind of okay on that. And so the whole thing is Wall Street it's a fad machine. It's a copycat business, okay? And it's all about control of other people's money. This is one of the fads that would happen in 2007, 2008, which was the international stocks. And this is kind of in vogue again, but the big thing now is, of course, the ETFs, and that's another fad, and target date funds, which I hope we can get into later on.
Yeah, they're always designing new ways to take your money and to keep it as much as possible. They're always coming up with some new strategy that can't lose. But the whole goal with Wall Street is that you have to give them your money. That's the whole point, and they have to keep it for as long as possible. That's their goal. And many people don't quite realize that when you start taking the fees, and when you start now this is not to say, by the way, I want to backtrack just for a minute and say this is not to say that someone cannot have a successful stock picking career over the course of their investment career. That is not true at all. We do see people who do succeed. The point here is that for the average investor who's just investing through their 401k, maybe trying to turn their current contributions into their 401k into a nice sizable retirement income, the deck is stacked against you. So I think that's what we're trying to talk about tonight. Let's talk about some of the bank failures. We've seen a lot this year. This chart goes back to 2009, Barry.
Yeah, this is 2009, and as I say, the greatest failure of banks is during the Great Depression, where 10,000 banks failed. The savings loan crisis was 2,900 banks thereabouts. But in 2010, I think we had 140 banks fail, and I think we had another 400 or 500 on the failure or could fail list still. And the major problems, of course, are the community banks or the smaller banks. The bigger banks, the Citigroups, the Bank of Americas, all these guys, have essentially been bailed out by the taxpayer, and they have essentially money for nothing, and so they're not in really that bad of a shape.
And so then we have the FDIC, which stands.
Yeah, I get a kick out of this. When I was coming, I found this with my son, is that you buy a toaster and get a bank, and the reason why I get into that is that look at these major banks that failed. Washington Mutual, the largest mutual savings bank in Washington, which had Long Beach mortgage. Now it's now in the belly of the beast of J.P. Morgan. We got Bear Stearns. So Bear Stearns was known as the savviest risk manager on Wall Street. Can you believe that? Merrill Lynch lost, was it $27 billion in one year in 2008. Freddie Mac, taxpayers took it on that. Fannie Mae, same thing. AIG, largest corporate bailout in the world. Wachovia, they spent $26 billion buying the Golden West mortgage portfolio, which $120 billion of mortgages, Alt-A liars loans. Now they're in the belly of Wells Fargo. And we got Countrywide Bank, Andrew Mazzilla's bank. He's not doing any time. Matter of fact, the Bank of America, I think, just paid his 28th Mac Bank, which is now One West, which is owned by George Soros and J.C. Flowers, and there's some interesting YouTubes on that, and that's really been the taxpayer taking hosing on that one. Then the Hume Bank, and then the Arkansas National Bank. So these are major banks which have failed, and we're supposed to believe these guys, trust us? I don't think so.
You know, it's something because the FDIC, you know, is an interesting organization in the fact that it does have credit lines, Barry, with the Federal Reserve. It has credit lines with the Treasury. And so in essence, you know, it can always just print, you know, it can request more printed money, and then it can bail out banks and bail out banks. But, you know, I was reading the latest statistics. I was putting together our quarterly newsletter that's coming out in April, and I was just looking up some of the recent data on the FDIC. And they are currently responsible. You know, this institution that was put into practice, put into place after the Great Depression to prevent a meltdown of the banks, to provide some sort of a cash infusion in case anybody ever caught on to the Ponzi scheme, the fact that only 10 cents out of every dollar was in the bank at one time, that they could actually be bailed out. And the FDIC is currently on the hook for $5.4 trillion federally insured deposits. And so there's $5.4 trillion out there in the banking system that the FDIC is supposedly on the hook for. And they currently have an insurance fund of negative $8 billion. So they're supposed to come up with $5.4 trillion with negative $8 billion in the bank. And so they're bankrupt. I mean, they're completely bankrupt. They're bleeding. And nevertheless, you know, the confidence game continues on. We have a tremendous perception. You know, everything is perception now. We have a very faith-based economy.
Yeah, it's all an illusion, unfortunately, and it's all about perceptions, and perception can be deceiving. And the fact of the matter is, the American public is being deceived on a grand scale. And
I don't want to act as if, you know, the FDIC couldn't prevent a bank, you know, wouldn't be able to back up and honor its stuff. I mean, there's no doubt that the very last thing the federal government is ever going to do is not print more money and give to the FDIC. The problem is they're going to inflate the dollar by doing that. They're going to inflate your, destroy your purchasing power. But I don't think, Barry, that they ever allow the FDIC to go under, because that obviously would be, that would be obvious.
Yeah,
it'd be chaos. They'd rather print money than allow, you know, a bank to not be FDIC insured, if it was. Okay, let's talk about this next.
Okay, the next thing which you're gonna fall is that we've already seen the subprime hit, but so what's going to happen is these the liar loans, the alt-A loans, the the negative amortization, that type of stuff, that hasn't reset yet, and so that's been one of another ways. No one's really talking about it. Another major failure in the credit horizon is the private equity leveraged buyout loans, which is not even showing up here. But so there is more turbulence to come, and anyone who is saying there's not is just kidding themselves. And so there is more mortgage wipeouts coming up, and despite what you read in the Wall Street Journal and everything, people are really hurting, and there's tremendous problems with mortgage foreclosures and so forth. So we're not through with this yet. And the major problem is the alt-A, the liars loans, which reset. They were 3-5 years. And they were sold in 2007, and they didn't reset for 5-6 years. So
we get a lot of questions. We get a lot of questions here, Barry, about is now the time to buy real estate? Especially with the rates being low. And we've been saying the same thing that you have about the subprime mortgages, and then of course the new option arm and the alt-A's, which weren't due to reset until this year. So we saw, we saw and we still see this thing not shaking out for another 2 or 3 years at least before it all just kind of settles down. The problem is, in 2 or 3 years, I don't see how we still have these artificially low rates. So it's kind of a trade-off. If you live in an area now where, housing prices have not been demolished and it's not terrible, maybe it's time to stick the toe in the water with interest rates being fairly low, because certainly, Barry, they're not going to be this low forever.
No, and they get, Jerry, as we know, they have to go up. I mean, we can't print this paper and not give people back a fair return on their money. So interest rates will have to go on. Again, I would go conventional fixed mortgage. If they're going to do something like that, And look at it as a home more so than as an investment. Real estate is just a very treacherous place to invest, even though it has been a great investment.
Just a quick commercial here. As you know, these are free webinars, so we don't sit here and bombard you with all kinds of ads and tell you have to buy everything. There's a lot of webinars out there. I've noticed. I've signed up for some, and it's just a constant barrage of just sales pitch after sales pitch. Folks, we don't do that here. What we do is we give you great content, but we're obviously a business, and so we want to tell you what we do. We want to make those things available to you. So we don't pester you. We don't send you ad nauseum emails trying to sell you things. But we do want you to know who we are. And so we want to make you aware tonight that we do have on our website, ftmdaily.com, we have a real simple button on that website that takes you to another website, a company that we own called the Christian Financial Advisor Network. It's fast, it's simple, it's free. If you're looking for someone in your area that subscribes to your beliefs and values, you want somebody who has a biblical worldview, that's what we have at cfanetwork.org. Simply go there, fill out the brief online form. And an advisor from your area, we have advisors in 43 states, an advisor from your area will get in touch with you within 3 business days. Barry James Dyke, by the way, is a part of that, and he is up in New Hampshire, and he covers some of the surrounding states up there as well. So anyway, I wanted to make you aware of that, cfanetwork.org. Let's continue on with the presentation, Barry. Let's talk about human economic life value.
Yeah, that's the this as we know, Jerry, and I don't know if you put the next slide from the World Trade Center disaster. I can't remember. I haven't seen what you put up there, but at the end of the day, Jerry, the greatest value of all the creator of all property value is the human life, and we all know this. We've all worked with entrepreneurs and people who've been anything. Look at Stephen Jobs. I mean, look what he's created. I mean, of Apple. I mean. Even Bill Gates. I don't like Bill Gates that much, but look what these guys have created. And so the greatest value of them all is the human life. And I think when people look in protecting their assets, they really have to look at the human life, their economic value of their life. And number of economists. This is really it's all based upon not just economic theory, but the courts. And this is Peter Singer. He came up from the professor of bioethics at. Oh yeah, now we got Susie Orman. She has a new PBS special, by the way, and she advises against permanent life insurance, but she's up to the same old tricks. I watched her thing last night, and she's telling everyone, Jerry, to put their money into dividend-based paying stocks when she's the complete hypocrite, where she has most of her money in zero coups. But she tells people not buy life insurance, permanent life insurance, but her own parent company, GE, has over 4,400 executives have life insurance on their own life, a high cash value life insurance. And as a matter of fact, NBC is now owned by Comcast, or majority owner, and Brian Roberts has more life insurance than anyone I know of in the world. He has over $233 million in permanent life insurance, 223 million thereabouts. And so what she says and what her people do are different. Now, these are going to be the GE executives, okay? Jeff Immelt, he's the CEO of Federal Reserve. He's on the Federal Reserve Bank in New York. He spends $127,000 a year, actually up now. Sharon Neal Rice, and Susan's boss, Bob Wright, he left, but he was spending $697,000 a year on life insurance premiums. So what Susie was saying, what people were doing, were two different things. So there's a complete contradiction as to what Susie was saying, what her own executives were doing.
Okay,
this is all.
So Barry, basically what you're saying is, up to this point where we are now, what we're starting to do now is we're starting to show how what the for a lack of a better word, what the overlords do is different from what the peons do. In other words, they use kind of like Susie Orman to be their puppet, to sell their securities, to push all their money into Wall Street, to give them money, because many people don't understand that these guys who take money on Wall Street, they don't just take your money and sit it in a pile. I mean, they're taking your money and they're doing stuff with it. You know, they want your money, they want it systematically, they want to hold your money, and they want to keep your money. And what's interesting here is that there's a lot of people out there who are puppets for Wall Street, designed to bring money in to the glorious casino That way there's always plenty of money and champagne flowing. But the problem is what you're exposing here, Barry, is that what these guys are saying for us to do, keep your eyes on your net worth. Don't worry about cash flow. They worry about cash flow. They don't care about their net worth. They care about their cash flow. But they tell us, don't worry about your cash flow. Don't worry about multiple streams of income. Just get a job, work that job, and also on top of that, put all your money into your 401k, max out your 401k. Who cares that it's government controlled? Who cares that they can change the rules at any time? Just put all your money into your 401k, max it out. Max out the traditional IRA. Make sure you put all your money in these target date funds like you're talking about. Make sure you put them all in mutual funds. Keep it all there because that's what you should do. But meanwhile, Barry, look what they're doing. Look how are they spending their money? Are they putting their money?
Well, they're complete hypocrites, Jerry. And the thing is that, and this is, and I filed these comments with the SEC and the Department of Treasury, even our senators. The fact of the matter is, and then I've actually done some more research on this. Actually, ML and all these guys have probably 2-3 times the amount of insurance on their own life. All their pensions are guaranteed by annuities and everything else. These guys don't take any risk. And the whole and the grand scheme is that they're shifting all the risk onto the regular people. For themselves, they take no risk.
Okay, so why would Jeffrey Imel put $127,000 into a life premium? Well, why in the world? What's the benefit to him for doing that, as opposed to?
Well, he must get it. It actually because he understands it's a good thing. It's a good thing, and he gets it. I mean, Jeffrey Imel. I mean, the stock is. I mean, GE's been humbled. I mean, we've lost half its market value in the past, but he still has a very rich pension. So the people have to understand is that these executives, all the responsibility, all the risk has been dumped on the regular people. These guys have no risk, but they do this because it's a very, very smart thing to do.
All right, let's take a look at some of the other executives that you uncovered as you were going through this. These guys who...
Brian Roberts, yeah. He's the guy now who... Comcast is now one of the largest media companies in the world now. So Brian Roberts, on his life, has $223 million of permanent life insurance. The 1-year term costs, Jerry, on it because it's paid up. Actually, Comcast says this is paid up life insurance. The PS 58 costs are like $3 million a year. Other guys, Ray Arani of Occidental, Culp of Danaher, Chambro of General Dynamics, Seidenberg of Verizon, McKinney of Boeing. These are all amounts of permanent life insurance they have on their own life. And again, it's not just about life insurance, but these guys also have tremendous amounts in annuities and fixed accounts. So we're not just talking about, we're talking about very smart people, Jerry, do not put their money at risk. And one of the blessings I've had in my life, in my career, I've dealt with people over $100 million. And guess what? You know what they don't want to do, Jerry? They don't want to speculate with what they got.
So these rich guys who are running these companies, the stuff that you basically found out, they're not taking the risks that what we're hearing on Wall Street, telling people to do, throw your money in gamble in ETFs, try to find the next best stock, put all your money in a 401k. They're not following that advice, are they?
No. As a matter of fact, I have a personal friend who's worth, up to over 50 million, 70, close to 100 million. And the whole thing is that, based upon your book, he says, I'm out of the market. He's got all his money in munis, real estate, treasuries, small businesses, real estate, cash flow, and things. Really wealthy people. I mean, I'm not against stocks, Jerry, or investments, please. But I'm just saying, with really wealthy people, when they make their money, they don't put it at risk. They put it in munis and treasuries and life insurance, annuities, that type of thing. Oh, Primerica, yes. Primerica is still part of Citigroup, and Primerica tells people to buy term insurance 100% of the time. But Primerica, which is still part of Citigroup, it was spun off by Warburg Pincus in this past year. But Citigroup still owns 51% of the company. They told everyone to buy term insurance, but Citibank, which is the bank of Primerica, actually purchased $1.1 billion of permanent life insurance in 2006.
So Primerica, aren't they the ones that came up with the buy term, invest the difference kind of concept?
That is correct. Yeah, and the people who made a fortune in selling that whole philosophy, Jerry, was Arthur Williams, the coach. he made all his money, and really the only people who really made money in that was Williams, and that was the whole deal of Sandy Weill's Citigroup, which ended up being the worst run bank in the world, which has been bailed out by the taxpayer with $50 billion in TARP money and $300 billion in backstops. But one of the only places Citigroup didn't lose money was in the life insurance account, Jerry. That's probably the only place that Citigroup didn't lose money.
Barry, one of the things that I found very interesting in my research, and I believe from your book as well, is this, and many people don't understand this, especially if they're just kind of going along and they're not in the financial services industry. They don't realize the cosmic struggle that exists between the mutual fund world and Wall Street and the insurance companies. And by the way, friends, tonight, this isn't a sales pitch for life insurance. This is basically what we're doing here is we're showing you something that I think is very interesting. So when you hear life insurance, don't think that's, we're trying to sell life insurance. What we're trying to do here is show you that the guys at the top are not taking their own advice, that they're peddling at the bottom. And so here's what I want you to see, this cosmic battle between life insurance companies, who technically started the whole financial planning industry, and the mutual fund companies. They struggle. They're in a cosmic battle for your dollars because they're both very different type of entities. And wouldn't you say, Barry, that the mutual funds have just won the arm wrestle pretty much hands down over the last?
They've taken it over. They have essentially they've hijacked America's savings plans, and there's no. They've bought it. And I'll be getting this into my next book because I had a document. They essentially bought the system, and so and the whole thing is, it's not just about life insurance, but it's about the annuities and so forth, and which are so much more safer than these funds. These funds they have more moving parts than the Navy and more destructive power.
What's so amazing about this is that buy term and invest the difference concept. I've got to tell you, that one takes the cake. That was probably one of the most brilliant strategies of the mutual fund arm of Wall Street that I've ever seen, because what they were able to do is just basically say, just buy a policy that, like 97% of term policies actually expire without paying. Only 3% of people who buy a term policy is what the recent statistic that I saw. Are actually,
yeah, University of Pennsylvania.
Yeah, 3% of people who buy it, you're paying 50, 60, maybe you're paying 100, 200, maybe you're paying 300 or 400, whatever you're paying per month. 3% of you buying term insurance are going to cash in on that. You're actually going to expire during your term. But of course, on the permanent side, those who actually pay their premiums, they're going to get it. But obviously, because of that, term is cheaper, and so the mutual fund said, "Hey, just buy term. In fact, we'll get in the business and we'll promote term, and then what we'll do is we'll take the difference and we'll be able to push it into mutual funds." And so it's a brilliant strategy that they have, and Primerica is the one. And it's interesting that Citibank, who owns Primerica and says we only do term life insurance, that's all we do, they themselves, they don't have.
Exact opposite.
How much term insurance does Citibank have?
None. But the funny thing is, and not just talk about annuities, but William Harrison, who was the CEO prior to Jamie Dimon, the golden boy of Wall Street, William Harrison actually got his pension guaranteed by a life annuity. It wasn't nothing to do with a life annuity for J.P. Morgan. So this is not made up, Jerry, and I assume we're going to be getting into some of the bank-owned life insurance pieces. But okay, now we're getting into the Victims Compensation Fund. This occurred to me, and again, this occurred to me that this is the largest life insurance payment of all time, Jerry. Everyone knows this was when the World Trade Center got hit. What happened, Jerry, was actually $6 billion got paid out in essentially life insurance claims, because it was life insurance, because there was no income taxes, and it was all based upon the economic value of the human life. And this just goes to show that the human life, has the greatest value of them all. Now, the perturbing thing about this, actually the disgusting thing about it, some of the people, as you see down there in the bottom there, I mean, you had traders working on the 100th floor of World Trade Center, guys making over $4 million a year, actually had no life insurance. So my point is that unfortunately the Wall Street traders, and this is tragic, they all died. Some got claims as high as $7.1 million. Whereas a guy from Iraq, I don't know, or Afghanistan, what does a soldier get now? $450,000.
If that.
But this is all true. So these are the actual government statistics of claims paid out, and this is all life insurance. But the thing is, it came out of not from a life insurance company, but from the United States Treasury, which is you and me, the taxpayer.
So we've talked about some of these different things. Let's talk about where the banks invest their money. Obviously, the banks hire the best. They always try to diversify away the risk as much as possible. They're always trying to prevent that. Why do banks buy so much life insurance, Barry? Where are banks putting their money, and why do they buy life insurance?
Well, they're more stable than banks. Always have been, always will be. They're not leveraged. They buy life insurance because it improves their income statement, which is a big deal for Wall Street. This is ghoulish, okay, Jerry. It's better for the consumer, okay, but it provides the bank a phenomenal return, non-correlated return at death, which is not related to the stock market. It's the ideal funding medium for executive pensions, life insurance placed discriminate on top 35. As I just mentioned, William Harrison, who was the CEO of J.P. Morgan, got his pension. Kenny Lewis, Bank of America, got his pension from that. Benefits when the people die come into the bank, income tax free, just like people.
That's a huge benefit right there. Tax-free income at death, and even tax-free income if they borrowed from the cash value or the cash value during their life, right?
Yes. Ideal. They use it. They have to have a state insurability reason for insurance. They have to file this with the state. So they use this for ideal medium for help their benefit costs. It's just a good economic investment for them. Life companies better manage economic risk. If people think that banks can manage risk, look at the 2007, 2008. These guys were idiots. They all would have failed without the government bailout. I didn't see life companies fail. Federal Reserve and life companies are very highly liquid. There's no taxes or gains on investment income for the bank.
So when somebody puts a dollar into a bank, some people may understand fractional reserve banking. When you put money into a bank, basically the bank can almost lend out almost all of it. They got to keep a little bit just for good measure. But at any one time, they've only got 10 cents of every deposit in the bank. And so if more than 10% of the people come back looking to get their deposits, there's not enough there. That's why they borrow from each other overnight. That's why they have lending rates. That's why they have federal funds rates. That's why they have. That's why they tap that's why they're members of the FDIC. That's why they borrow from member banks. Life insurance companies are different. When you put money into a life insurance company, how much of the money do they have to keep in store, Barry?
It's 100% reserve based, Jerry, as you know.
So the money has to go in and it has to stay there.
Exactly, and the problem with the the last line here, which we're coming up here, is this is not Barry being crazy here, but this is the risk weighting given to them by the Federal Reserve, the Federal Deposit Insurance Corporation, the Office of Thrift and Supervision. They essentially place life insurance with a 20% risk weight, which is not gold, but it's the darn closest thing to it. So life insurance companies are not gold, but it's better than just about everything else. And so this is gonna be an interesting one. Yeah, this is all true. And I've been looking at these numbers so long. All these banks, Bank of America, Wells Fargo, J.P. Morgan Chase, U.S. Bank, Key Bank, Branch Bank, Bank of New York Mellon, all these banks have more money invested in life insurance, cash surrender value, than they do all their fixed assets and their real estate combined. This is all true. I got this from the FDIC, and the thing is that, and no from the Times, the Journal, and they all know who they will publish this data, and but this is all true. So similar, even like J.P. Morgan Chase has more money invested in life insurance than all their fixed assets combined.
That's something.
Why do they do this? PNC, Pittsburgh National Bank, which is a giant curse of the U.S. taxpayer because they bought up Nat City. First Tennessee, I put that in there because that's Dave Ramsey State. Harris National, Huntington National, M&T Bank, Bank of the West, which is actually BNP Paribas, a French bank. RBC, which is actually the Royal Bank of Canada. Marshall & Isley. I think they just got bought by a Canadian bank. All these banks, again, have more money invested in life insurance than they do in their fixed assets combined.
Now, you mentioned Dave Ramsey. He's another one of these types that is out there promoting mutual funds and you know, annihilating cash value life insurance, even though the ones at the very top own it.
Yeah.
Similar to Susie Orman, I guess.
Yeah, Dave, I agree with Dave saying, you know, there's people out there, but Dave, unfortunately, he misinforms. He's fleecing the flock, and he's not giving people the full story. Bank of New York, this is my favorite. Bank of New York Mellon, and this is all true. Is this they had this is before they merged with Mellon Bank. They had Tier 1 capital of $5.5 billion. Boley, which is bank-owned life insurance, of $1.7 billion. So the bank had 31% of their bank invested in life insurance, and they had more money invested in life insurance on the bank's balance sheet than they had in their entire defined benefit plan. In this bank, the Bank of New York, which sells itself as a carriage trade asset management bank, lost on a 5-year period on their own pension plan. They had a negative return of 2.92%, Jerry. They would have been better off sticking into an annuity. So here's a carriage trade bank selling themselves as an asset manager, couldn't even invest its own funds very well. It's all true. HS Hong Kong Shanghai Bank Corp, okay, and I put this up here because you can see, I know people can see the line down there, 14. I saw them, they advertised for term insurance, and yeah, oh, you got it right there, Jared. Beautiful, beautiful. This is a bank that sells on television. They advertise for term insurance. Hong Kong Shanghai Bank Corp has their money. It has $200 million. They put $200 million into pension, into life insurance as a core asset. And they're registered in Delaware, as you can see, so they can sell credit cards. ING Bank, the savings bank. How about this? Where does ING put their money? In high cash value life insurance. So the Orange Bank, which is registered in Delaware, once again because of the credit card and no interest rates ceiling, the Orange Bank put their own money into high cash value life insurance. Could make this stuff up, Jerry. E-Trade, which is owned by Citadel, which was bailed up in Kenny Griffin's Citadel hedge fund, which is great friends with Barack Obama. They would have failed with their investments in subprime mortgages, but they put $250 million into high cash value life insurance, and they're registered in Virginia.
Okay, just a quick commercial. This is stunning stuff, friends. You know, just finding out where some of these financial companies actually hold their money and where many of the executives hold their money. And by the way, our FTM quarterly newsletter, we have our next issue coming out April 15th. It's a quarterly newsletter. It comes out every single quarter on the 15th of January, April, July, and October. Our latest issue coming out, we talk about many different ideas. Precious metals, multiple streams of income. We actually have a report we're getting ready to come out with the 15 streams of income. We've talked about these before, but 15 multiple streams of income that you can create in retirement. We're talking about these. Annuity and insurance strategies, some of the things that Barry's talking about tonight. Agriculture, options and stock trading, emerging market investing, small business ideas, retirement income strategies, energy, international real estate. If this is some of the stuff that you're looking for, the FTM investment portfolio and the FTM quarterly newsletter is for you. We also run a portfolio here. The portfolio currently invested in about 17 different areas, and we give you full-blown access to that real time. Anytime we do a buy or a sell, you're able to see what we're doing. And so anyway, just if you're interested, $129 per year, go to ftmdaily.com, and we would love to get you signed up for that, to get you on the and we'll throw in the last back issue from January if you sign up anytime between now and April 15th. All right, Barry, let's keep going here.
Okay.
Let's go ahead and move into a final word here because we're kind of getting toward the end. A final word on target date mutual funds. Barry, these are the ones that many people got forced into recently in their 401ks, and many people may recognize these as the mutual funds that have target dates on them. Like maybe you're going to retire in 2025, so the fund is called the 2025 fund. Or maybe you're going to retire in 2035, so it's the 2035 mutual fund. And so talk to us a little bit about these. These have got some pretty interesting points to them.
Yeah. Okay. These are this is a travesty. This is why I'm so passionate about it. These essentially were put into play by the Pension Protection Act of 2006, which was essentially an airline pension bailout bill. But these were put into play with the Pension Protection Act of 2006, which gave two things: automatic enrollment and choice of default investment. And more than 140 billion flowed into in 2008 for a total of 227 billion. This is as of last year. And now, Jerry, today they've gone up over 100. They're up to 330 billion now since I've done this slide. So this is where the money is flying into mutual funds today. These are the one-size-fits-all target date funds, which are a fund of funds, and they're awful. But these are the default investment. Just to give people just a little United States amnesia, what happened, and this is the Federal Reserve figures. In 2007, there was $3.7 million in 401k. In 2008, there was $2.6 billion. So Americans lost over about $1 trillion in mutual funds in 401ks, and most of this, a large chunk of this was actually in target date funds.
So these funds are created now. The SEC is investigating these things right now.
Oh, it's a joke. It's a joke.
Are they getting any traction, or is the investigation
No,
over?
no. What it is, Jerry, is the thing is slap some disclosure on it, and just like saying you can lose more, you can lose your principal, and that's the way it's going to be. Now, of course, the hypocrisy of the SEC and the Department of Labor and everyone else is that our own government regulators don't participate in these things. So they, it's disclosure like putting on cigarettes, they can be dangerous to your health, and that's what SEC is doing. And essentially, they've caved to the mutual fund industry.
And the big idea about these, Barry, if I understand it correctly, is that the perception is that if it's a 2025 fund and I'm gonna retire around 2025, then I think, oh, that's the perfect investment for me. So I just go ahead and start gearing all my retirement assets toward that. First of all, I don't even have an option. I have to go. It's a default. I have to go tell the HR department that I don't want that fund because that's where it's going to default. Isn't that correct? It's a default fund?
Yeah, it's tragic. It's tragic, and no one understands it. As a matter of fact, I'm doing the research in the next book, Jerry, and the thing is the employers don't understand them, the employees don't understand them. There's no ways to measure them. No one can figure them out for life. I can't figure these things out, but they're the default investment. And so, I can't compete with BlackRock or Fidelity and Goldman Sachs, whatever, but they're all gunning after your money, and this is the new flow of money. And when these state pensions collapse, and they are going to, there's more at stake here. So this is why these things are coming out. It's all about control of the money. Follow the money, Jerry. That's why I love your show and your website. It's follow the money, and people will figure it out.
Peter has a question, Barry. Peter says, so does this mean that there are tons of ordinary Joe people out there who are buying cash value policies so that these banks have them to invest in? Am I missing the boat not to invest in one for myself? Answer that question.
Well, no. I mean, the banks buy this for very good reasons, and actually it's better for the consumer when they get it. I mean, everyone's different, Jerry. They need an advisor, but it actually makes more sense for the consumer as a warehouse for savings, because money must reside somewhere, and it actually makes more sense for the individual. Each person is different, but no, it's not a bad thing to do at all.
So like when these companies set up a cash value life insurance, but many people don't know how they work because the mutual fund, like you say, and like I've been saying, mutual fund companies, they rule the universe. That they really do, and so they
own the press.
They own the press. I mean, they're you take a look, friends, at the commercials that run at night. This thing is rigged. I mean, from the very get go, And they have taught you, look at how many people fail economically. Look at how many people fail financially. There was a report from the Wall Street Journal talking about the 401k and the failure of it. Not to say that saving is bad, and not to say that 401ks inherently are bad, but the idea is that many people look at the 401k as the silver bullet. Most retirement plans today are a house and a 401k. Both of those are government controlled. Both of them are highly illiquid, and then both of them, you can suffer pretty big tax on when you go to sell it. And of course, there are some tax benefits with a house. The 401k, on the other hand, the distribution taxes can change at any time. And the concern with this Wall Street Journal report was basically this: many people are going to reach retirement, and they're simply not going to have enough money saved. And so we're predicting from 2020, Barry, to 2030. This is about the time when all those who really didn't have a pension, this is kind of the very beginning of the baby boomers who just started getting the 401ks. About 2020, they start retiring. And from 2020 to 2030, you talk about massive retirement headaches as people try to retire, but they don't have enough in savings to be able to make money stretch for the rest of their longer lives, thanks to pharmaceuticals and whatnot like that. So we have a real big headache coming on, and gosh, how many more people can afford to retire in the middle of a big stock market crash? Everything the stars have to align lately for people really to be able to retire in such a way where they can actually do so with peace. And these target date funds, Barry, they seem to kind of create that illusion that said, okay, if I'm retiring in 2025, I just simply put my money on this. And what's the problem, Barry? They're losing money?
They're off. Some of them lost 50, 60% of their net asset value, okay, in 2008. And they act like hedge funds, Jerry. They're investing in derivatives, commodities, real estate, high-yield junk bonds, or actually junk bonds to fund leveraged buyouts, you name it. There's a lot of crap in there, and people don't even know it. And we're going to bring this to the light, and it's tragic, but it's all true. And what happens is their 401k mutual funds end up being dumping grounds for Wall Street, and probably not one person in 100 can figure it out. Thank God I understand this.
Paul says, I don't know how I will ever get to sleep tonight. This info has me that rattled. Paul, again, keep your peace, but at the same time, take this as an eye-opening. Really, this is Wall Street's dirty little secret. They push and peddle things. Obviously, they do not have your best interest at heart. We can say that completely, knowing that that's the truth. Anybody who knows the human nature knows that these guys in Wall Street, they're not looking out for you in the least. And so, whatever they're selling you, you've got to kind of follow the money. You've got to look behind. What are they really pushing here? And that's not to say, Barry, that insurance companies are perfect either. But you're saying
no, they're not angels, okay? But there's contractual guarantees, there's laws, there's regulations. They have to the reserve ratios, there's mathematics. There's a lot of good, solid mathematical and engineering behind them. Okay, these guys don't care. And anyone who contacts me, I can tell them they're all lost billions. Fidelity to everyone else.
Michael has a question. He says, "Am I using wisdom in my retirement plan? I have several annuities, some farmland." Hey, that's really good news.
That's good. Yeah, that's gone up well lately.
And some investment in silver and gold. That's really good. He said, "I'm 67 years old with a little Social Security and a state pension. What do you think about that plan?"
Sounds pretty good. Knowing what we know, he's got Social Security. That's not going to go away. He's got some state pension, which is good. He's got annuities, and which is solid, and farmland, which is unfortunately looks like there's going to be no asset bubble in that. But I've been hearing from people around the country that farmland's really going up, and so the caller sounds to be in pretty good shape. More so than other people.
Yeah, it does sound good. Annuities, that's lifetime stream of income. You get your state pension, that's a lifetime stream of income. You have Social Security, silver and gold, which is only going to go up, over the course of the next 5 to 7 years. Obviously dips, but long term we see that going up. Farmland, who knows? But certainly so far it's been a good bet. By the way, you go ahead, Barry.
Yeah, and actually, a client of mine, I was speaking to a client of mine in Colorado yesterday, and he said, Barry, we're the Saudi Arabia of the food in the world, So farmland's a good thing.
Yeah. And Michael, let me ask you, I know there's several different ways to invest in farmland. Some people even just seek out a broker and just buy it themselves. I'm just curious, you don't have to go into great detail, but just tell me, was it something that you just bought and you actually farm on yourself, or your family farmed on it, or did you actually seek out to invest in farmland? I'm just kind of curious. Okay, Jan, and while we wait for his answer, Jan has a question. Do you have some advice for your listeners related to what we should be investing? She wants to know what the positive things are here. What should they be investing in rather than term life and target retirement funds? So in other words, what are some good areas to be in, Barry, as opposed to what we've already talked negatively about?
Well, as I say, obviously, each person is different. This is why people need an advisor. But obviously, cash value life insurance is we've just shown the people how much the banks put into it. Annuities are a good thing, obviously. Cash is going to be king, from the days that people, going to have to, save because people who have cash are going to have opportunities. Obviously, gold, hard assets, Jerry. I've been talking about that stuff for 5-6 years, and now look where it was at, $1,400 or something like that now. Mm-hmm. Anything which produces income, other things we're talking, small businesses and things like that. I'm not against stocks, okay, but people have to do the research. I'm not against stocks, but look at something like Apple. I mean, it's which has been a favorite of mine, but so I'm not against. I'm just saying, people, do something you have some control in, okay, and put. I say, maybe have 67% of your money in safe or liquid things, Jerry. Would you agree or something like that?
I think so. I mean, it all depends on what age they're at and everything. I think you're so right when you say to invest in yourself. I mean, the importance of creating streams of income are so vital. And you know what's interesting, Barry, is that one of our 15 streams that we talk about is cash value life insurance. I like life insurance because of that fact. Number one, you put the money in. When you put the money in, it takes some time to build the cash value. But what's nice about the cash value life insurance is that if you let's say that you want to start a cash value life insurance policy. Let's say you wanted to start something like a $100,000 or a $200,000 death benefit. You start putting money into that. And it's just like if you started putting money into a CD or you started putting money into a money market at the bank. Well, once you start making that premium payment, and then God forbid, the Mack truck theory, you walk out on the street and you get hit by a Mack truck, guess what? Your heirs, you receive not your measly, $500 that you put in the money market, but they get the $200,000 that you had as the death benefit. But if you keep putting money in there, then it turns into cash. Then if you go take that cash out and you take it in the form of a loan, it is a non-taxable event in most cases. So therefore, you're taking money out of it and you're basically borrowing from it. And because you're borrowing from it, you don't pay taxes on it. And then at the time of death, it transfers to your heirs income tax-free. I mean, it boggles the mind. You put money in and it's tax-deferred, and then you pull it out and it's tax-free. Sounds like a Roth IRA to me, but
it's better.
But yeah, it's a rich man's Roth because rich guys can't put their money in Roths, because it's because they don't qualify. So Roth IRAs, I think, are very good for that reason. You put them in tax deferred and then you pull them out tax free, and all the activity going on the inside is tax deferred and then tax free when you pull it out. But I think the cash value life insurance is strong. Investing in your own business is very big. We have a question here. Jane says, so how does a life insurance policy benefit somebody who doesn't have any heirs?
Well,
is that
again, it's a way to spend down assets. But again, life insurance may not be for everybody, Jerry. If someone's single, whatever. I think what I'm trying to show people in this webinar, if you will, is that the life companies are better managers of people's assets, and and some people they're not candidates for it. But if some people they love something other than themselves, whatever, it could be a way to leverage your estate, and you can also use it for reverse mortgages and so on. And
well, now we have some more questions here before we continue on. It looks like let's see. Michael, first of all, comes back with his answer. He was the guy who had the farmland. He said the farmland was an investment in case of an economic meltdown. Good idea, Michael. I like this.
we like that one.
Yeah, but he said, I've leased it to a rice and soybean farmer for the present. Not a great deal of income is coming off of it, but it does pay tax on the land with a little extra. So it's nice. You get an asset, and it doesn't cost you anything. So it's kind of
that's good. Sounds good.
Let's see. Cynthia. Hey, Cynthia, good to see you. Okay, and Cynthia says, I was getting ready to buy term insurance, so it sounds like I should be checking into cash value life insurance instead, correct? What do you think, Barry?
Yeah, well, yeah, again, everyone's different, whether they're young, single, married, divorced, whatever, okay? Yeah, because again, term insurance, as you know, term insurance is another Wall Street product. They want us to buy mutual funds and term insurance. They want everything to be with cost on it. Whereas the thing with the whole high cash value life insurance is the only thing without a lost opportunity cost. So they want to, it's easy to sell, okay, you need to do it with an advisor who loves and cares, something about you and your family. But, yeah, it's something people should consider.
Alicia says, because the banks are so heavily invested in cash value life insurance like you're talking about, Barry, is it less likely that the government will try to change laws to tax it? Because currently it's tax-free at death. Do you think that we could see a change in the laws because many companies are investing in it?
I don't know. I don't think that the government has a clue. But I don't, what if anything, you would see a history of grandfathering. Again, some of these banks, Jerry, we didn't get to some of these banks had as much as like Wachovia, before they were taken over by Wells Fargo, actually had 38% of their net worth invested in life insurance. But I don't foresee it. It's one of the only things that works. Do you follow me? And why would they? Well, I can see the government screwing up anything, but life insurance, because of the inherent design of it, okay, it works. So I don't see why they would get rid of it. Even if they could maybe change the tax benefits with it, but I'm not sure. It's still a great deal today if they bought it today.
We have a couple of more questions. First, a comment from Paul. Paul says, may I suggest that one should be encouraged to steward his own money than to surrender control of it to another person who will make more money off of his money than he will. And Paul, I tell you what, that's one of our
Amen.
That's one of our primary things that we talk about here is to get educated, to commit yourself to financial education. Now, that's not to say that we don't need advisors. Even the Bible itself says that there is safety in the multitude of counselors, so we don't want to turn away good advice. But you're right. We need to be very careful just about handing our money over and saying, here, HR department, handle my money, or here, financial advisor, I have no clue who you are, just take my money and turn it into gold for me. We need to be very, very careful. Don't you agree, Barry?
I agree with you. Yeah, and the thing is, as you know me, Jerry, I'm not just doing this for the money. I'm just doing it because I'm just so tired of Americans getting hosed about this stuff. And to me, it's a moral. To me, it's morally devastating because, and we're going to see the consequences of this not now, but 5-10 years from now. So the more we get the truth out there, the better off people are going to be.
There was a question, Jan. I'm going to ask your question, but in a slightly different way, because it is a good question. The question was around the idea of retirement plans. Can cash value life insurance be placed into, and by the way, this is something that you don't ever hear about, but can it be placed into an individual retirement account? Can it be placed into an IRA?
No. Matter of fact, again, this is the power of Wall Street. Actually, they used to be able to be placed into 403B plans, which is a great deal, which is the 401k for the teachers and not-for-profits, okay? Up to about 2 years ago, Jerry, you could put your money into it, but then, of course, the mutual fund industry didn't like that because of the competition, so no, you cannot do that anymore into an IRA or into a 403B. You used to be able to do that with a 403B, but the mutual fund industry saw that as competition, so that was essentially kicked out.
Hey, that's the one takeaway I want you to take away tonight. What Barry just said, and that's the main thing. your action tonight doesn't need to be to run out and buy cash value life insurance. That's not the takeaway. The takeaway from tonight is you need to realize that what's coming out of Wall Street is biased. And I know it's very easy for you to believe. I could joke and say that it's hard to believe. But the truth of the matter is that there is this cosmic battle that the mutual fund companies are desperately trying to prevent you from putting money anywhere else. They want your money in paper assets at all times. That's why the gold and silver industry is put down. That's why every time gold or silver drops, what happens? What happens on CNBC? What happens on the news media? Oh, has gold peaked? Has silver peaked? Is it over? They're hoping, they're praying, please, because they want you to put your money back in paper assets. Don't take any money away from their paper assets. That's why they also say, oh, don't spend too much money on cash value life insurance, buy the real cheap term, and then invest the difference by giving it to us. We want to take your money. We can be trusted with it. So that's the takeaway tonight. What I want you to realize is that many times some of the negative things that you hear in the financial media is not because the product is necessarily bad. It's because somebody is not getting a cut, and that's why they don't like it. And I want you to keep that in mind tonight. That's really the thing. Okay, another question here, Barry. Okay, this is a really good question. Really, and I'm Chris, great question for asking this. How does cash value life insurance fare in times of high inflation, Barry?
That's a great question. You know, the thing is that is a great question, and this is it. The thing at which I'm saying, cash still has to you still have to be liquid in cash, and cash must reside somewhere. The problem is with inflation. Chris is a great question. We're all paper assets are really vulnerable in times of high inflation. I won't disagree with it, but this is why you have to have other things, you know, gold and your own business and things like it, really other skill sets. But the thing is, if you're looking for your family, you're looking at the whole macroeconomic, it's still a great deal, even in high times of inflation and stability, because, you know, if there's a market crash, and I don't know what's going to happen, folks, but I smell another rat again. It's people will have their value, and the fact of the matter is the Federal Reserve, which is our private central bank in the United States, had 70%, I repeat, 70% of their 401k, not in target date funds, but in fixed annuity contracts, major U.S. life insurance companies. Now, this is all documented, and let's get into this right now. So, federal government misinformation. TARP and the federal government and the Federal Reserve choose fixed products and guaranteed products.
Yeah, there was a story that came out about Ben Bernanke's, you know, and of course Wall Street worships him, and they all watch his every move, just like they did Greenspan. And here's Bernanke, who knows the score. I mean, people call him ignorant, they call him stupid. I mean, the guy's the high priest of finance in Washington, and where does he have his money? The story came out. The majority of it was where, Barry?
In annuities. Half of it, he had about $1 million liquid, and half of it was in a variable annuity with an index, and then the other half was a fixed annuity at 6%. And I was actually the guy who dug this up, by the way. I went through the federal reports and reported on this, and but it's all a matter. He has to do a disclosure, and that Ben Bernanke actually that's where he makes that's where he has most of his liquid money. Actually, Ben Bernanke makes most of his money from textbook sales, and again, that kind of plays to my whole thing about investing in yourself.
Another stream of income. So he has money tied up in annuities. It sounds like he might need to sit down with Dave Ramsey or one of his advisors, or he might need to sit down with Yeah, I mean, maybe they can talk some sense into him because they certainly seem to know more than he does. Federal government thrift savings plans. Talk about this for a minute.
Okay, this is the TSP. This is the largest 401k in the world, folks. This has gone up to like 270 billion since I first did this. The G fund, which looks, feels, tastes, and is just like an annuity. It's so darn big. No one, life insurance company can even issue it. It's a annuity contract essentially guaranteed by the U.S. Treasury. So the thrift plan of the United States federal government, which is the largest 401k in the world, most of it is invested in fixed accounts. It's that little 19% lifestyle fund, which is another way for target date funds. that's where target date funds. So the federal government is not doing what they tell people to do. All true. And this is all filed, by the way, with Senator Cole and a bunch of other people, and but they won't reply to me. But this is all true. And by the way, people can go on the web and get this themselves. Go to tsb.gov. So this is as of 12/31. This, by the way, I think I'm shaking up their case at the Federal Reserve. You cannot get this off the Federal Reserve anymore. But this is, you see the green section there. That's what is called their interest income fund. If you go to the, you can't get this information off the web anymore. But this is as of the third quarter of 2009. The Federal Reserve had 70% of its own assets in their 401k in fixed annuities. So the Federal Reserve, the Central Bank of the United States, which has more PhDs in economics than any place in the world, has most of their money in fixed annuities. Surprise, surprise. Again, this is something which, again, we get Time Warner here. This is the Time magazine saying everyone should have like a guaranteed insurance account, which is essentially an annuity, which they're talking about. This is they're saying because the whole thing has failed, and they have failed miserably. And this is something that's already existed, Jerry, as you know.
Absolutely.
Yeah, absolutely. So.
Well, let's move back into our questions before we conclude for the night. Let me go back here and let's see. Let's take a look here. Some of the questions. Yeah, Chris had a good question there on the, on the inflation question, and I think Paul has a follow-up to it. Barry, I didn't know that. I didn't know that about the new law about the retirement plans, because you used to be able to put cash value life insurance up to, I guess, was it 50% that you could?
Well, no, you could actually put it. It's still a viable interest if you have a qualified plan. A KEO plan, a defined benefit, a defined contribution, a profit sharing plan. No problem. You can still do it. And actually, it's a great deal. And actually, people doing more small business people doing that than ever. The problem is an individual IRA or TSA account you can put it in a 401k, but you can't put it into a TSA.
Okay, so that goes back.
You cannot put it into an IRA.
That goes back into Jan's question about.
Which is tragic.
The 401k, you can put cash value life insurance into your 401k.
Yes, you can.
So why isn't
it has to be for everybody?
So why isn't that broadcast to the HR department? How come we never hear about that? Is that, again, that goes back?
Because how do you compete with these these mutual fund wholesalers with their $1,000 suits and their Lexuses and their it's very difficult. And
they show up and they feed you lunch and they show you these big mountain charts and they say if you would have
and I sold benefit plans, as you know, Jerry, and I was very successful for 20 years. And in the HR game, it's a game of flash, and unfortunately, a lot of these HR people do really not know what's going on. It's tragic, but they have limited resources, so we just got to educate the people the best we can.
So that would be a good, interesting thing for people who are listening who do have a 401k. If you are interested, that'd be the very first step. You could just go contact your HR department and say, hey, is it possible for me to get out of this junky fund that's returned me negative 15% for the last 5 years and maybe put it into something like, cash value life insurance that won't give me a negative return each and every year, and I can sleep at night. So that might be a good idea, or to contact someone else about that. But anyway, so good point. Okay, let's see here. We also have a question from Jan. How does one find the best way to purchase the cash value policy, and with which company? How can we rate the companies to make sure that we're not buying from a company that could be going under? What's the best way to do that?
Well, the thing is, you have to understand is that life companies, by their very nature, and I'm kind of a snob. I deal with mutual companies, so that means they're owned by the policyholders. So, and the thing is that you have to understand, in the past 100 years, not one person that I know of, either in the United States or Canada, has lost a dollar in life insurance companies, and because they're all legal reserve companies. So, depending upon what state the person in, they're all legal reserves, so they really can't be. Even if a company did fail, and there have been some failures, okay, very few, but if they do fail, they have to be bailed out by the companies who are doing business within that state. And to the best of my knowledge, no one's lost money. Even when First Executive collapsed in Los Angeles in, I think, '88, and that was because of junk bonds, everyone made their money up on the company. So no one has lost money within a legal reserve life company. They have lost money with mutual fund companies all the time. So, good question.
Yeah, and so if they want to find a good cash value life insurance policy in their area, obviously, friends, we do have our Christian Financial Advisor Network, cfanetwork.org. You can find a Christian financial advisor in your area, but you can also just contact. If they don't want to do that, Barry, what's the best way? I mean, they phone book. I mean, they need to talk to somebody they know. I mean, they need to be careful because in the insurance business, just like in the financial services business, just like anything, you always have your good eggs and your bad eggs.
Yeah, I mean, I think you want a person. It's not just about insurance, but they want to look at your whole financial picture, Jerry. As you know, they want to have some expertise in looking at their casualty insurance and the retirement plan. Someone who knows something about taxes and the whole thing. If someone's just going to try to sell insurance, don't do business with them.
Yeah.
And to the listener, and you really want someone who really helps you integrate and coordinate all this stuff. With the wills and so forth, as you know, because they're. Life insurance is a will unto itself. So, or you need to have someone to coordinate the your retirement plan as well, because they're. So you really want someone who knows what they're doing, and the Christian Financial Network is a good thing. Then check around.
Paul has a question. In periods of higher inflation, wouldn't the dividend yields and cash value policies be higher, so as to compensate for the inflation? So the increasing.
Yeah, that's a very good point. As interest rates go up eventually, and they will. That's the kind of the weird thing about it is that the great thing about it, and this is the great thing that people don't realize, life insurance companies manage interest rate risk. And I tell you, boy, even personally, in my own family, we got killed investing in bonds in the 80s. My father died, and it was tragic. And interest rates went up to 18%, and my mother lost half of her portfolio because of interest rate risk. Life insurance companies retain the interest rate risk. And Paul's point is very good, well taken, because when interest rates do go up, they will go up eventually. The dividends will be higher because the life companies will be able to lock in on higher rates of return. And very good point.
Well, we also have a question here, I believe, from I can't tell the first name, but it says, will interest rates like the swap rate, the index that the banks get charged, go up with the other rates?
Yeah. Yes.
We have a question from Rob. Hey, Rob, good to see you there. Can you still convert traditional IRAs into Roths for 2011, Barry?
Gee, that's kind of a CPA question. You have to look at the whole income and all that other stuff, and I believe you can. I mean, I have a problem is that I don't think people should be converting them. I think it's a way for people for the government to get money out of people.
Mm-hmm. Yeah.
I don't think it's for everybody.
Bleed money from the top. Well, I guess it all depends on how much money that you have. If you have a whole lot. Yeah. In your nearing retirement, our idea is, if you're only 5-7 years off from retirement, it's probably not really worth it, but you're going to have to pay a lot of money right now.
And that's supposed you can't take it out of the account.
Yeah, and so it's going to slow.
Technically, you can't take it out of the account. So
right. So it's going to slow you down. But if you're 20, 30, 40 years away from retirement, moving over to that Roth now, instead of paying the piper 40 years from now when this empire is completely crumbling, and who knows what tax rates will be, maybe to get out of the game now, But
sure.
Okay, well, I tell you what, that brings us to our conclusion. If you have any final questions, feel free to ask them now. We'll be here just for another minute. We're almost at 9:30. We want to wrap this up in our 90 minutes. We want to tell you that on our website, we talked about gold and silver a little bit tonight. If you're interested in learning more, we have a webinar just like this, with our precious metals guy, Tom Cloud. If you haven't heard that, many of you probably have, but if you haven't heard that, that's available. It's on our website. You can download it just like this one's going to be available later. If you like this one and you haven't heard the other one and you want to learn more about precious metals, go check that out. Just go to ftmdaily.com, click on the precious metals button, and listen and watch that presentation with Tom Cloud. We talk about precious metals, investing 101. You can learn a whole lot from that. And I want to conclude by reminding you that, if you are looking for a Christian financial advisor in your area, CFAN. It's cfanetwork.org. Financial advice one click away. It's fast, it's simple, it's free. You don't go on any list. We totally protect your privacy. It's a small company, but we're just trying to help people find good financial advisors who have no SEC violations, that have no insurance commission complaints, that don't have any kind of insurance claims that they've had to pay out, and they've been in the business for at least 10 years. These are the good guys. We kind of screen our folks pretty well, and we put them into the network, and then we're very sensitive to any kind of concerns immediately. So far we've had really good success with the people who are here, and if you're interested in finding somebody in your area, just go to cfanetwork.org. If you happen to live up in the New England area, your advisor would be Barry. Barry, you live up in New Hampshire, and you kind of cover what states up there? You cover.
Well, actually, in New England, it's funny. I do more business out of New England than, I have clients in Colorado and California and stuff like that. So it's just now with the book and so forth, which is the bestseller. But New England area, and anywhere in New England, New York, New Jersey, anywhere, So
I guess with technology the way it is, you can really just do anything.
Yeah. And so a lot of people, you can just be done over the phone now, for people, and it's worked out well.
Excellent. Well, Barry, it's been a pleasure. You have opened up many people's eyes, I know. Let me just go back and check our question box one more time before we do. Let's see. We got people saying great seminar, great, thank you for the webinar, really good. Let's see here. Yeah, Paul is saying that he would like for Barry to contact him.
Okay.
We can arrange that. Let me go ahead and stop the recording now. Great to have everybody here.